Topic number 8, risk and return. These are the concepts and skills that you'll be learning in this topic and chapter outline. Now, let's look at the first outline, that is expected returns and variances. Now, what is expected returns? Expected return in finance means average return. To calculate average return, you have this formula. This, you must have probability, you must have individual return. Then when you have probability and individual returns, multiply each other and add this all up. So you get the expected return, VER. Let's look at this example. You are given the following individual returns for stock C and T in 3 possible states of nature. What are the expected returns? Now, first, you have the state probability C and T. State means that the 3 situations where the economy could be in booming, could be normal, it could be in recession. Alright, probability. Now, the total probability must equal to 1 or 100%. So here is 0.3, 0.5 means 0.8 in total. So here the question mark, so probability for recession should equal to 0.2, so that the total probability equal 1. Alright, 15%, 10% and 2% are the individual returns. Okay, for stock C, the same. 25, 20 and 1% is the individual return for stock T. Now, so now we are answering the question, what is the expected return for stock C? So expected return for stock C is probability times individual return of stock C. So 0.3 times 15%, 0.3 times 15% plus 0.5 times 10%, right? And plus 0.2 times 2%. Add all up, you'll get 9.9%. That is expected return of stock C. Now, what about stock T? The same process apply. Probability times individual returns of stock T. 30% times 0.3 times 25% plus 0.5 times 20% plus 0.2 times 1%. Add up equal 17.7%. That is expected return for stock T. Right? Now, what about variance and standard deviation? Variance and standard deviation is a measurement of volatility of returns. So you have this formula. That's the formula to calculate variance and standard deviation. So the way to calculate variance is you must have RI, that is individual return, minus expected return that you calculated just now, multiply by probability and take the square of it, so add all up. Now this is the variance. For standard deviation, the difference is you take the square root of variance. Now, question asks, consider the previous example. What are the variance and standard deviation for each stock? Now, why do we need to consider the previous example? Because we got to refer to the probability, individual return, and also expected return that we calculated just now. Let's see, what is the variance of stock C? Now, that is the formula, right? We must have the individual return and the expected return and the probability. Let's look at stock C. Stock C. Here is the probability, here is the individual return, and this is the expected return. So we have to use these figures. Alright. Probability for the first state. Probability times 15% minus the expected return that we calculated just now, it is 9.9%. So 9.9% to the square plus second state 0.5 probability times 10% minus 9.9%. 10% minus 9.9% to the square plus probability 0.2, 2% minus 9.9% to the square. Alright, and add all up, you get the variance. Now to get standard deviation, take the square root of variance and you get this. Now the same, what about stock T? Variance and standard deviation for stock T. The same thing applies, right? Let's look at stock T. Now you have this probability, there's the individual return, and this is the expected return. So use the probability times individual returns minus expected return. Alright, let's look at this one. 0.3 right, times 0.25 minus 0.177. That is the expected return that we calculated just now. Take the square plus 0.5 times 20% minus 17.7% to the square plus 0.2 times 1% minus 17.7% to the square. Add all up, get the variance, and take the square root, you get the standard deviation. Alright. Now, look at this example question asked. Right, consider the following information. You have 4 sticks here, so the probability is 1 in total. So here 0.25, 0.5 means 0.75, 0.9 and plus 0.1, that is 1. In total, probability must equal to 1. Now this is the return on the stock. The stock name is ABC. Stock return on ABC. Is the individual return. So question asks, what is the expected return? So the solution must be, you use the probability times the individual return, which means 0.25 times 15% plus 0.5 times 8% plus 0.15 times 4% plus 0.1 times negative return, that is times negative 3%. So you get a answer. What about variance? Variance apply the same formula. That's to use the probability in individual return minus the expected return to the square. Right? You can see from the solution there. So use the probability 0.25 bracket, right? 15% minus the expected return that you get here to the square plus 0.5 times 8% minus the expected return here to the square plus 0.15 bracket 4% minus expected return here to the square plus 0.1 times negative 3% minus the expected return that you obtain here, then take the square and add all up, you get the variance. What about standard deviation? Take the square root. Alright? Refer notes for solution. Now, let's go to the portfolio. What is meant by the portfolio? Portfolio is a collection of assets. If I'm having more than one stocks from different industries, then I can say myself is having a portfolio. So when I say I'm having a portfolio, which means that I have more than one stocks from different industries. So now you have to learn how to calculate the expected return for a portfolio and standard deviation for a portfolio as well. Now for just now, what you learned was about the expected return and standard deviation for an individual stock. Now you have to learn expected return and standard deviation for a portfolio. So how is it? According to the slides, the workings are just the same as the way that you did for individual stock. Alright, let's take a look. Now, portfolio weights means that before calculating the expected return and the variance for portfolio, you are to have the probability, what we call as weights. Now, you have 15,000 to invest, and you have to chase the following stocks. So you are having a portfolio that consists of 4 stocks, 4 different stocks. What are your portfolio weights in each security? It means what are the probability in each stock here. Weights means probability. Now, just like the previous example, you must have the probability. So we must calculate the probability. Now, in total, you spend 15,000. So stock number 1, DCLK, you spend 2K, KO stand 3K, INTC 4K, and KEI 6K, in total 15K. So what is the probability of it? The probability for stock number 1 is 2K divided by 15K. This is how you get 13.3%. 3K for stock 2, 3K divided by 15K, right? Get 20%. 4K divided by 15%, you get 26.7%. And last one, the probability is 6K divided by 15K, so that is 40%. When you add up all this probability, it must equal 1 or 100%. Alright, let's see how you can calculate the expected returns for a portfolio. So the same thing, we use W here. W means weight or probability. So W times expected return that you calculated just now, add all up, then you get the expected return. Let's have a try for this question. Now, question says, consider the portfolio weights computed just now. So you already computed the portfolio probability of weights just now. So now you are given the following individual returns for the stocks. So question asks you, what is the expected return for the portfolio? So these are the individual returns. So to calculate the expected return for a portfolio, you must have the probability and the individual returns. So just now we already computed. It's just like the way to calculate the expected return for the portfolio. You must the way to calculate the individual return. So you must have the probability and you must have the individual return. So see, you have 13.3 times 19.65%. Now 19.65% is the individual return. So we must have this probability. Where do we get it? Now just now we computed. So that is the probability. 0.133 probability for stock 1 times individual return of stock 1 plus weight of stock number 2, 0.2 times individual returns of stock number 2, right, plus weight of stock number 3, 0.267 times individual return of stock 3 plus weight number 4, weight stock number 4, 0.4 times individual return of stock number 4. So add all this up equal 10.24%. So you can see that the process of calculating the expected return for a portfolio is actually exactly the same as the way to calculate the expected return for an individual stock, where we combine the probability with the individual stock return. So the same for this, you combine the probability with the individual stock return. Alright, now we are going to learn the variance of a portfolio. Alright, let's see how you can calculate portfolio variance. So to calculate the portfolio variance and standard deviation, we will use the same formulas as for an individual asset, which means the workings are actually the same. Let's take a look. Now, this is first we review on the expected return and the standard deviation for each asset. For each asset means for an individual stock. Now, how do we calculate? We must use the probability times its individual return. So you can see the probability here. and the individual return for stock A and B. Alright, so how do you calculate for A? So there are two states here. So total probability equal 1, 0.4 plus 0.6. So now we use to get the expected return for stock A. So you are to use 0.4 times 30% plus 0.6 times negative 10%. That's how you get the individual stock return of stock A, right? 6%, right? Probability times individual return plus probability times individual return, so you get 6%. What about stock B? Stock B the same, probability times individual return of stock B. So 0.4 times negative 5%, 0.4 times negative 5% plus 0.6 times 25%, 0.6 times 25%. So add up with 13%. That's the expected return for stock B. Then what about the next part? There is the expected return and standard deviation for the portfolio. So you have to use the portfolio formula. Now, right? Let's see. This is the portfolio. Now, in our portfolio, we are having two stocks. They are stock A and stock B. So how do we calculate? Now, based on the question, we know we invest 50% of our money in stock A and the other 50% in stock B. So our money is divided equally in A and B. So from here we know the probability the probability of our money spent in stock A is 0.5 and for B the same 0.5. So you can see from the solution is 0.5 plus 0.5, stock A, stock B. So what about 30%? Where do you get this 30%? Now we spend 50% of our money in stock A. So stock A you receive 30%. That's individual return of stock A, individual return of stock B. So 0.5 times 30% plus 0.5 times negative 5%, right? You get 12.5%. That is portfolio return. So that's what you can see here, 12.5% for portfolio if the state is BOM. Now, what about if the state for a bust? So 0.5 times negative 10% plus 0.5 times 25%, you'll get 7.5%. That is the expected return in the bust. Now we want to combine both BOM and bust states, right? So for the BOM, the probability of having a state of BOM is 0.4. So 0.4 times the portfolio return in BOM plus 0.6 times the portfolio return in bust. So add up is the 9.5% expected return for a portfolio. Okay. Now, what about the standard? What about the standard deviation from the portfolio? Okay, varies for the portfolio. So we must have the probability, the portfolio return minus the expected return. Let's take a look. Alright, probability 0.4 bracket portfolio return in the state number 1, there is 12.5%. Alright, then minus, right, you see 0.4, 12.5% minus 9.5%. What is this 9.5%? That is the expected return of the portfolio 9.5% that you calculated just now. So take the square plus 0.6 times 7.5% portfolio return of stock state 2, right, minus the expected return of the portfolio 9.5%. Take the square, then add 2 up, you get 6%. That is the variance. To get the standard deviation, how do you do it? Take the square root of 6. So you get a standard deviation of 2.45%. Alright, and you have another example that you can refer to for solutions. Okay, now we go to expected and unexpected returns. Now, expected and unexpected returns are different. Alright, for realized return, they are not equal to expected returns. Realized means already you got the return. There's your return. Expected return, there are two components in the expected returns. So first component is the expected component, and second component is the unexpected component. Unexpected component is one that you unexpect it to happen. For example, you might be having a surprise news, right? Or surprise component in the stock price, right? So for example, like the announcements or the news that the company could make when you are holding the stock. For example, like suddenly there's an announcement saying that the project of this stock is failed. So this is called unexpected component or surprise component. Right. Efficient markets. Now, in efficient markets involve random price changes because we cannot predict surprises. So surprises, the unexpected components we couldn't predict. So we call it as efficient markets. So involve random price. Random price changes means unpredictable price. Okay. Now, so for there are two types of risk in the market. First, called systematic risk. Now, systematic risk is a risk that affects all stocks in the market. So systematic risk is also called as non-diversifiable risk or market risk. Now, systematic risk is undiversifiable. Why? Undiversifiable means that you have nowhere to run away from facing the risk. For example, is the market risk. Market risk is a risk that will affect the whole market in general. So it means that all stocks listed in the Busan Malaysia are affected by the market risk. So you have nowhere to run away from facing market risk. So that's why it is undiversifiable. Now, for example, like changes in GDP. GDP will affect the whole economy, will affect all stocks in the market. So it is undiversifiable risk or systematic risk. Inflation is a market risk, right? Interest rate is also a market risk. So this risk will affect all type of stocks listed on the Busan Malaysia. So undiversifiable. Now, what about unsystematic risk? Unsystematic risk is a risk that will only affect a limited number of stocks. It will only affect certain stocks. For example, so let's take a look. For example, like CEO of stock number A, stock A passed away. So this news will only affect the performance of stock A. So it's only meant for the stock A. So that's why it is also known as the unique risk or asset specific risk. So asset specific because only meant for the asset. Unique is also because meant for the stock A only. Now, systematic risk is diversifiable or undiversifiable. Unsystematic risk is diversifiable or undiversifiable. For systematic risk, it is undiversifiable. So for unsystematic risk, it is diversifiable. Now, so unsystematic risk is diversifiable. How do you diversify it? By investing in different type of stocks. So if the performance of stock A is not well, then it can be offset with the good performance in the stock B, C, or D, and the rest of the stocks. So by diversifying it, then you by diversifying your portfolio, then you can diversify away the unsystematic risk. So that's why unsystematic risk is also called as diversifiable risk. So expected return, as I say, there are two components, right? Unexpected and expected components, right? Total return having two components, expected and unexpected return. So for the unexpected return, there are two components, systematic and unsystematic portion is what we learned just now, right? So unsystematic portion. Alright, so which means that for risk, the total risk is systematic risk plus unsystematic risk. Right? So now we see diversification. Now, portfolio diversification is the investment in several different asset classes or sectors. It means that portfolio diversification means you invest in more than one stocks, and these stocks are from different industries. For example, if you own 50 internet stocks, so you are not diversified. Why? Because all stock from the same industry, that is from the IT industry. Now, what about if you own 50 stocks but from different industry? Yes, you diversify your investment. Alright. In other words, is do not put all eggs into the same basket. It's called diversification. Okay, take a look. The more different stock that you invest, the smaller the standard deviation. When the standard deviation is smaller, so it means that the risk is lower. Alright, so that's what you can see here. Alright, let's look at the principle of diversification. Now, there is a minimum level of risk that you cannot be diversified away. What is that? There is the systematic portion. What is that? Systematic risk. Systematic risk is undiversifiable. So there's no way for you to diversify away this risk. Why? Because there's market risk that will affect all stocks in the market. So that's why you can see undiversifiable risk. You have no way to diversify. So it's the same regardless the number of stocks in your portfolio. But for diversifiable risk, it can be diversified away when you increase the number of stocks in your portfolio. So the more stocks that you invest, the lower the diversifiable risk. So you can see here, if you hold the stock, let's say here is about 3 stocks, then there's the much of diversifiable risk that you need to face. That is the stock specific risk. But if you increase your the number of stocks to 40 stocks, then there's much of diversifiable risk that you need to face only. But the non-diversifiable risk is you have nowhere to diversify it away. Alright? So diversifiable risk, the risk that can be eliminated by combining assets into a portfolio. So that's what we say, unsystematic risk or unique or asset-specific risk is the diversifiable risk. If you hold only one asset in the same industry, then you are not diversified in your investment. That means that you are exposing yourself to the diversifiable risk. Alright? Standard deviation of return is a measure of total risk. Okay? We learned the standard deviation just now. Now, for well-diversified portfolio, unsystematic risk is very, very small. Why? Because the unsystematic risk has been diversified away because of well-diversified portfolio that you can see. For a well-diversified portfolio, so when you increase, when there's a lot of stocks in your portfolio, so the diversifiable risk is very small. It's very small. So the total risk for a diversifiable portfolio so is essentially equal to systematic risk. Why? Because unsystematic risk for a diversified portfolio is very, very small. So the only type of risk that left in a portfolio is systematic risk that is undiversifiable. Alright. Systematic risk principle, that is undiversifiable risk principle. Undiversifiable risk means that you have nowhere to run from facing the risk, for example, market risk. So because of varying market risk, so you will be awarded. So now, if you hold unsystematic risk in your portfolio, so there's no reward. Why? Because unsystematic risk is diversifiable. So if you diversify the unsystematic risk, if you diversify away the unsystematic risk, then you need not to bear the risk. So that's why, since you can diversify away the unsystematic risk, so that's why no reward for bearing unsystematic risk in your portfolio. Alright, as we say, the expected return for the asset is on a risky asset depends only on the asset systematic risk. Why? Because systematic risk is undiversifiable, and the unsystematic risk can be diversified away. Alright, how do we measure systematic risk? Systematic risk is undiversifiable. That is the market risk. So how do we measure the market risk? We use beta. Beta equal 1 means that all individual assets have the same systematic risk as the market. If less than 1, so it means asset is less, individual asset is less risky compared to the market. If more than 1 means individual asset is more risky than the market, more risky in terms of systematic risk. Alright, so we are now going to see total versus systematic risk. Alright, differentiate total versus systematic risk. Now you are given standard deviation and beta for security C, for stock C and D. Now which stock or security has more total risk? Now total risk is measured by standard deviation, so we should look at the standard deviation. So which stock has higher standard deviation? That is stock K. So the answer is stock K has more total risk. Now next question, which stock has more systematic risk? Systematic risk is measured by beta. Alright, beta. So it's a measurement of market risk. So which one has higher beta? That is stock C. So stock C has higher beta, so has higher systematic risk. Now which stock should have higher expected return? Return will only be awarded for those who bear market risk, that is measured by beta. So not looking at standard deviation, but look at beta. So stock C has higher beta, so stock C should be awarded with higher expected return. So the answer is stock C. Now let's see. Just now we had gone through this example, right? There are 4 stocks in our portfolio. So now how do we calculate the portfolio beta? The same, right? If you can see here, rate means probability, so add up must equal 1. Here is individual beta. So to calculate portfolio beta, so you have to use the probability or the rate times its individual beta. So 0.133 times 4.03 plus 0.2 times 0.84 plus 0.267 times 1.05 plus 0.4 times 0.59. Add up, you get the portfolio beta. Actually, the way is exactly the same as the way to calculate expected return. There's use probability times beta, individual return, but here is probability times individual beta, right? Probability times individual return. So here is probability times individual beta. So the workings are actually the same. Okay, so you can see they are actually the same. Now, the higher the beta, the greater the the unsystematic risk, right? The higher the beta, the greater the market risk. The greater the market risk, so the greater the undiversifiable risk. So the higher the beta, the greater the undiversifiable risk, so the greater the risk premium should be. Risk premium means the reward. Because of bearing higher beta, higher undiversifiable risk, so because of bearing higher market risk, so you are to pay with higher reward. So expected return beta is a measure of market risk. Alright, so you can see the higher, now if the beta is 0.5, then the expected return that you get is about 13%. But if you are bearing 1.5 market risk, so you will be awarded with 20%. expected return. So means the higher the beta, the higher the expected return, the higher the reward. Okay, reward to risk. Okay, let's take a look at this diagram. There are two lines here. What we call this line as SML line. So this is to show the relationship between market risk and expected return. Market risk is measured by the beta. When the beta equal 1, you get this reward. Now, as an investor, you will prefer to have a steepy SML line or this line. Alright, you will prefer to have a more steepy line, right? Why? Because for every unit of beta here, let's say if you bear beta of 1, right? If the SML line is very steepy, then you will be awarded that much, right? But if it's not steepy, then you will be only awarded with that much. Alright? So now, there is a formula what we call as CAPM model, right? Capital Asset Pricing Model. This is to show the relationship between risk and return. Is actually this is the equation for getting this line. Alright, so the formula is RF plus beta times market return minus risk-free rate. RF is risk-free rate, B is beta, RM is expected market return. So this actually is a formula of obtaining this equation, this line. Okay, let's take a look. So as I say, this is a CAPM model which is used to calculate the expected return. So of stock A, so which is we use the risk-free rate plus beta expected market return minus risk-free rate. So what is risk-free rate? Risk-free rate means those return that you can obtain from asset they are riskless. But what is the risk-free security? There's the securities issued by government. So we have the treasury security. So treasury security means issued by government. So when it is issued by government, so it should be risk-free because government will never ever bankrupt. So this is called risk-free RM. Now, reward for bearing systematic risk, there's a market risk premium. So market risk premium is measured by RM minus RF. So here is the beta, right? It's a measure of systematic risk. Now, let's take a look. What is the expected return for each using CAPM model? Now you are familiar that the risk-free rate is 3.15% and the market risk premium is 9.5%. What is market risk premium? As the market risk premium is the output of expected market return minus RF. So for this question, you are already given the output, right? So you need not to minus again. So it is the risk-free rate plus beta times market risk premium. So you get 43% for stock A. And stock 1. Stock 2 you repeat the same. So risk-free rate plus beta times market risk premium. Right? Stock 3, the same risk-free rate plus beta times market risk premium. And the last one, the same risk-free rate plus beta times market risk premium. So you get the expected return for each stock. Okay, we have now finished all these questions and you may look for the solution. Okay, we have done for this. Now class, I uploaded some 2 links in the Times. Please go to the Times and then go to the links and answer the question as it is about e-learning. Alright, go to the Times and check it out. Alright, that's it for this lecture.